Less than 1% of the world owns any XRP. And yet the global banking system is quietly reorganizing itself around technologies that look shockingly similar to what the crypto space has been building for years. That gap between awareness and action, between those who see the shift coming and those who don't, is exactly where the real financial battle is unfolding. Banks versus crypto isn't just a catchy phrase anymore. It's a literal tug-of-war between a centuries-old structure and an emerging digital ecosystem designed to move faster, cheaper, and with far fewer middlemen. And XRP, somehow, has ended up right in the middle of that collision. Not by hype, not by accident, but because of what it was built to do. But before diving into the details, let me ask you something that actually matters more than price predictions or charts. If both sides, banks and crypto, are fighting for control of global money flows, which side are you truly positioned for? Not the side you like emotionally, but the side you're objectively prepared for. Are you structured for a world where blockchains dominate? Or for a world where banks adopt blockchain but keep control? Or are you unintentionally betting on both without a plan for either? That question matters more than most people realize, because whether you intend to or not, you are already choosing a side. What's fascinating is that banks didn't lose ground to crypto because they lacked intelligence or resources. They lost ground because they were slow. Institutional finance was built for stability, not speed. For decades, their only real competitors were other banks, not open networks anyone could join from a laptop. They operated in a closed loop with predictable rules, predictable bottlenecks, and predictable profits. Crypto broke that loop. It emerged from message boards, universities, hacker culture, places banks could easily dismiss. And for a while, they did dismiss it. But the trouble with exponential growth is that by the time the old system starts paying attention, the new one is already too big to ignore. Here's something uncomfortable but true. Banks don't fear crypto because it's innovative. They fear it because it threatens the machinery that generates their profit. Slow settlement, profit, currency conversion spreads, profit, intermediary banks, profit, delays, profit. A system built on speed and transparency annihilates these profit centers instantly. Imagine a world where cross-border transfers go from 2 or 3 days to 3 seconds. A world where clearinghouses aren't necessary. A world where intermediaries don't take a cut for simply existing. That world is great for everyone except the people who extract revenue from friction. And banks have been extracting revenue from friction for over a century. That's where XRP comes in. XRP wasn't built as a meme or as a speculative casino chip. It wasn't designed to be digital gold. It was built for liquidity, specifically to act as a neutral, fast-moving bridge asset between currencies, platforms, and borders. It isn't tied to a country. It doesn't rely on miners. It doesn't need slow confirmations. It doesn't have political allegiance. It exists to move value the way the internet moves information. When you frame it like that, XRP stops looking like a crypto project and starts looking like plumbing, a foundational layer. Let's take cross-border payments, one of the largest financial arenas on the planet. When a person or business sends money across borders today, the process is painfully slow. Your payment might pass through 3 or 4 intermediary banks before reaching its destination. Each intermediary charges a fee. Each adds time. Each imposes checks. The entire system operates like a chain of warehouses passing your parcel from hand to hand. It works, but it's inefficient, outdated, and costly. Now imagine replacing that chain with instantaneous digital routing. No warehouses, no middlemen, no delays. That's the battlefield where XRP and the legacy system collide head-on. And if instant settlement is so obviously superior, why haven't banks adopted it wholesale? Because they profit during the delay. If money arrives instantly, banks lose the ability to reuse that liquidity during the waiting window. That delay, known as the float, generates billions in revenue globally. The longer your money is in transit, the more they can do with it behind the scenes. Instant settlement destroys the float. For you, that's great. For them, it's existential. Understanding that changes how you interpret their behavior. Resistance isn't incompetence, it's self-preservation. People often talk about Swift versus Ripple as if it's a boxing match, but the truth is more nuanced. Swift is upgrading messaging. Ripple is upgrading value movement. Swift can tell banks, your money is coming, but it can't move the money itself. Ripple can move the money in seconds. Messaging without settlement is like sending perfect GPS directions to a car with no engine. Settlement without messaging is a car with an engine but no map. Combine both and you have the future of finance. The question is not which system wins. The question is who integrates both first. As crypto grew, central banks couldn't stay on the sidelines forever. They launched CBDCs, digital currencies issued by central banks. CBDCs are controversial. Some see them as tools of control, others see them as modernization. But regardless of opinion, CBDCs don't solve the cross-border problem. They solve domestic efficiency. When a CBDC needs to interact with another country's CBDC, you run into the same issue: different systems, different ledgers, different rules. Something has to connect them. That something must be fast, neutral, and interoperable. XRP fits that description almost perfectly. Whether or not anyone says it out loud, the architecture speaks for itself. Tokenization is the silent revolution that banks have been studying, testing, and preparing behind closed doors. They're tokenizing bonds, equities, real estate, funds, massive markets worth trillions. Tokenized assets move faster, settle faster, and reduce counterparty risk. But there's a catch. They still need liquidity. A tokenized bond denominated in euros may need to interact with one denominated in dollars or yen. Something must sit between them as the universal translator of value. And again, this is where XRP's design becomes relevant, not as a currency replacement, but as a liquidity facilitator. As markets get more tokenized, liquidity becomes the real king. And XRP is built for liquidity. One of the most misunderstood features of XRP is its neutrality. Unlike currencies backed by nations, XRP doesn't take sides. It doesn't represent a geopolitical agenda. It doesn't expand or contract supply at the whim of a central bank. For institutions, that neutrality is both useful and unsettling. Useful because it avoids the politics of choosing one national currency over another. Unsettling because a neutral asset challenges the control banks and governments have traditionally maintained over money movement. And in a world where trust between nations is eroding, neutrality is more valuable than ever. What's becoming increasingly clear is that banks can't ignore XRP forever. They can delay, they can test alternatives, they can experiment with private ledgers. But the fundamental problem, moving liquidity across fragmented financial networks, remains. Public blockchains, private blockchains, CBDCs, stablecoins, each works in isolation. Someone has to bridge them. Someone has to solve interoperability at scale. The solution must be fast, cheap, scalable, neutral, and deeply liquid. Very few assets meet those criteria, and XRP is one of the strongest candidates. Pressure builds slowly. Adoption happens suddenly. Family offices and hedge funds are beginning to see the writing on the wall. For years, many dismissed crypto as too volatile or speculative. But now they see structural weaknesses in the traditional system: rising sovereign debt, currency debasement, fragile monetary policy, and geopolitical instability. They aren't buying XRP for hype. They're buying it as a hedge. To them, XRP isn't a moonshot. It's insurance. It's exposure to a parallel system that might outperform when the old one struggles. These investors don't need XRP to replace anything. They just need it to function when it matters. This is also where the idea of a future supply shock gets interesting. XRP has a fixed supply. A large portion is locked in escrow with predictable releases. Meanwhile, retail tends to hold their XRP tightly. If institutions start accumulating, the amount of XRP available for trading could shrink significantly. Add in corridors that require liquidity, market makers that need inventory, and new on-ramps for tokenized assets, and the available liquid supply could drop even further. When demand rises against thin supply, markets move violently. Supply crunches don't announce themselves. They happen. And here's the statistic most people still don't grasp. Less than 1% of humanity owns XRP. Most people don't just lack XRP, they lack awareness. The average person has never read a white paper, never explored blockchain fundamentals, never studied liquidity theory, never examined settlement mechanics. They aren't late, they simply don't know what's happening. That's what being early truly means. Not owning something before it becomes expensive, but understanding something before the rest of the world even notices. Banks have adopted a new tactic. If you can't beat crypto, integrate it, but reshape it. That's why they're launching their own tokenization platforms, stablecoins, digital asset divisions, and blockchain experiments. They want blockchain's efficiency without surrendering their influence. They want speed without decentralization. They want the benefits of crypto rails with the governance of traditional finance. This doesn't eliminate assets like XRP. It creates frameworks where XRP can operate behind the scenes, enabling liquidity for systems that prefer to brand themselves differently. ISO 20022, the new global messaging standard, isn't hype. It transforms how financial data is structured, improving clarity and automation. When paired with near-instant settlement assets like XRP, it creates the potential for seamless global money movement. ISO 2022 itself isn't a trigger for price. It's a piece of infrastructure that allows advanced settlement systems to operate more efficiently. When infrastructure matures, markets follow. Looking ahead, the future of finance is almost certainly multi-chain. No single blockchain or currency will dominate everything. Instead, different networks will specialize, some for speed, some for security, some for privacy, some for throughput. CBDCs will coexist with stablecoins, tokenized assets, and decentralized finance. In that fragmented future, interoperability becomes the bottleneck. The network that can bridge systems smoothly will become indispensable. XRP's architecture positions it naturally for that role. Essential doesn't mean dominant, it means necessary. We may even witness what could be called liquidity wars in the coming decade. As more assets become digital, the competition for deep, efficient liquidity will intensify. Platforms will battle for transaction routing. Nations will compete for digital currency relevance. Exchanges, banks, blockchains, and fintechs will fight to control the rails that move value, not just the assets themselves. In a world where speed and neutrality matter, XRP is positioned uniquely. So, what does all of this mean for you, the viewer navigating this shift in real time? It means you're living through a period of financial transition that most people won't fully understand until it's already history. You don't need to predict every twist or pick every winner. You just need to recognize when the system beneath you is rewiring itself. And right now, it is. Banks are upgrading, crypto is maturing, regulations are crystallizing, nations are building digital currencies, institutions are experimenting with tokenization, and through all of it, assets like XRP continue proving their usefulness quietly, consistently, and globally. Banks versus crypto isn't a moral battle. It's an infrastructure battle, a battle between slow money and fast money, between controlled rails and open rails. XRP sits directly at that intersection because it was designed to solve the exact problems the modern economy is now facing at scale. The fight is already happening. The only real question left is whether you're watching it from the sidelines or positioning yourself with intention. Not professional advice, consult a qualified expert as needed.